Hello and good evening, everyone. We are pleased to welcome Vishal Divadkar, Partner and Head of Audit Assurance at MSK and Associates, to help us navigate the regulatory landscape through his session on March 25 year-end regulatory updates, today on InSync with BDO India. Thank you for joining us, Vishal. Over to you for your valuable insights.
Thanks, Pallavi, and welcome everyone to this session. So today we'll broadly touch upon some of the key accounting changes applicable for FY25 and also cover some key updates from our regulators, SEBI and NFRA, including some new areas like digital assurance as part of this session. Before we get into details, the convergence of various macroeconomic and geopolitical factors have created a volatile and uncertain environment in which a business's decision making and the accounting and financial reporting considerations have become extremely challenging. We see evidence of these challenges in the form of either banks failing or being downgraded, businesses struggling to raise capital, companies announcing layoffs. Some of the factors affecting business have been summarized on this slide, right from economic disruptions, including recession, monetary and fiscal impacts, interest rate increases or tightening of credit, continuing inflation, financial, foreign currency risk, climate risk, and so on and so forth. While each of these factors on its own poses challenges in the application of accounting standards, the convergence of these factors significantly increases the level of complexity involved, and therefore the amount of effort needed to develop significant accounting estimates, such as those on valuation of receivables, inventory, property, plant and equipment, leased assets, goodwill, etc. For example, as interest rates rise, debt covenant violations may increase, which could call for an evaluation of the debt classification or impairments and going concern considerations, amongst others. A company's annual report contains three key areas that provide insights into the business model and strategy: the financial statements, sustainability disclosures, and management's discussions and analysis, or the MD&A. Companies may face direct challenge from investors, regulators, and other report users if those insights are not connected. Climate-related matters and other uncertainties are under particular scrutiny. To achieve this connectivity, it is important that companies are both compliant with relevant standards and are continuously joining the dots between financial and non-financial information. These pose challenges equally for assurance providers and auditors to ensure integrity and trust is maintained. So we can begin with the key changes to accounting standards applicable for FY25. While there isn't much that is new and applicable, I will also cover a couple of emerging areas that have been introduced in the form of exposure draft following changes to global accounting standards and guidance issued by the Global Accounting Standards Board standards. To begin with, sale and leaseback transactions are common in asset-intensive businesses like real estate, infrastructure, aviation, or retail. In September 2024, MCA had released the second amendments rules to the Companies Act to amend the manner in which the sale and leaseback transactions are recorded in financial statements under Ind AS 116. The seller lessee is required to measure the resulting RUU asset based on the asset's previous carrying value that corresponds to the retained right of use. The seller lessee should recognize only the gain related to the rights transferred to the buyer lessor. Previously, Ind AS 116 did not clearly define how to measure the liability, particularly when lease payments were variable and not indexed or rate linked. Now there is guidance. After initial recognition, the general principles of subsequent accounting of lease liability will apply, such that no gain or loss with respect to the retained ROU asset is recognized. There is no method prescribed for estimated lease payments. They can be determined basis some methodology such as expected lease payment or equal periodic payments over the lease term. A methodology would need to be formulated by the company. As per Ind AS 8, seller lessees will need to identify and re-examine sale and leaseback transactions entered into since implementation of 116 and potentially restate those that included variable lease payments. Companies must reassess all such transactions and update their financial models and also their accounting that is required and of course disclosures. The other big change introduced in August 24 by the MCA was to notify Ind AS 117. Ind AS 117 establishes principles for recognition, measurement, presentation, and disclosure of insurance contracts and replaces the erstwhile Ind AS 104 on insurance contracts. This has been done with an aim to align Ind AS with IFRS. Ind AS 117 applies to all companies. It applies to insurance contracts regardless of the issuer, and therefore all companies could be affected and not just insurance companies registered with IRDAI. Hence, such companies would need to evaluate the terms of their contracts to determine whether the definition of insurance contract is met. Performance guarantee contracts, fixed fee service contracts, and group company warranties could get covered. Certain exemptions exist, such as for policyholders, contingent consideration, credit cards, etc. The MCA, through its notification in September, clarified that an insurer or an insurance company may provide its financial statement per Ind AS 104 for the purposes of CFS of its parent or investor till IRDA has notified Ind AS 117. This amendment provides relief to insurance companies who otherwise were required to apply Ind AS 117 for submission to their parent investor or venturer for inclusion in their respective CFS. Separately, through a notification in Jan 25, however, IRD has mandated submission of pro forma Ind AS financial statement for even insurance companies falling in the defined phases for FY 23 and 24 and 24 and 25. Moving on to some global changes and their impacts on Ind AS. Globally, there have been amendments to IS 1 with respect to classification of current non-current liabilities. It has been clarified that liability arising from loan agreements is classified as non-current if the entity has a right to defer its settlement beyond 12 months from reporting date. It is not dependent on whether this right to defer is conditional on complying with debt covenants after reporting date. However, with respect to covenant breaches, the position remains the same, i.e., if the breach has taken on or before the reporting date, then the liability is classified as current, even though there could be a settlement with the lender post reporting date. However, in Ind AS, there were two carve-outs in relation to this. Only a breach of material covenant will trigger current classification. But even here, if the lender agrees to waive or not demand the repayment, then the entity need not classify the debt as current. However, there was an exposure draft to amend Ind AS 1 issued by the ASB of ICI relating to classification of liabilities as current or non-current for breach and subsequent cure of financial and non-financial covenants. It aimed actually to eliminate this carve-out provided by Ind AS 1 to align with the classification of liabilities as current or non-current with the principles set out in under Ind AS 1 or IAS 1. The final outcome, however, of this is yet to be known. The carve-out, however, was, if you recall, was considered necessary given the operational and functional realities that are specific to the Indian business landscape and the banking sector. Discussions between lenders and borrowers, especially on matters of covenant breaches, is a time-intensive activity in India, and hence the borrowing entity may not necessarily receive a condonation of a covenant breach by the reporting date, even though the intent of the lending entity may be to ultimately provide such condonation. In such situations, classifying a debt as current when such breach would be condoned before the financial statements are authorized for issue may not result in a fair presentation. Similar treatment is there under US GAAP ASC 470. Thus, this is an acceptable method to classify the loan as it presents a more updated version of information available at the point of approval of financial statements. The proposed changes also provide guidance on how an entity classifies a liability that can be settled in its own equity shares. When a liability provides the holder a conversion option that involves a settlement by way of company's own equity instruments, the conversion option is recognized as either equity or liability separately from the host liability as per the requirements of Ind AS 32. The exposure draft clarifies that for the purpose of classifying the host liability as current or non-current, the company is required to ignore uh, the conversion option that is recognized as equity under Ind AS 32. Moving on, the use of supplier financing arrangements has grown significantly in recent years, driven by increasing focus on cash flow management and the use of digital platforms and the need for business to navigate supply chain challenges. As such arrangements increase, it becomes increasingly important that investors have transparency over the effect on the company's liabilities, cash flows, and exposure to liquidity risk. In response to the growing prevalence of supplier financing arrangements and their implications for financial transparency, in May 23, the IASB issued supplier finance arrangements, which amends IAS 7 on statement of cash flows and IFRS 7 on financial instruments disclosures, specifically targeting disclosure requirements. Corresponding to these amendments, the ASB of ICA has issued an exposure draft on supplier finance arrangements with proposed amendments to Ind AS 7 and Ind AS 107, via its notification July 2023, with actual amendments to the Ind AS expected soon. As supply finance arrangements may evolve over time, the term has not been defined in either IS 7 or IFRS 7 or in the ED that the Institute has proposed, because there's a risk of this definition becoming outdated as new practices and arrangements evolve. Instead, the proposals describe the characteristics of a supply finance arrangement in the proposed paragraph 44G to Ind AS 7, which explains one or more finance providers offer to pay amounts an entity owes its suppliers. The entity agrees to pay the finance providers at the same date or a later date than what the suppliers are usually paid, or an entity gets extended payment terms or supplier gets early repayment terms. These are some of the aspects that have been referred to as supply chain finance or reverse factoring arrangements. These are some of the proposed disclosure changes across the standards for example, the terms and conditions and the relevant balances in the cash flow statement, where such arrangements exist, whether they have been accessed or that provide the buyer with the extended payment terms or entities suppliers have been given early repayments. And of course, there are a few transitional reliefs provided for disclosure of comparative information. So we now move on to some updates from our regulators, NFRA and SEBI. So in its efforts to suggest measures for improvement in overall audit quality and to promote awareness and significance of accounting and auditing standards, auditors' responsibilities and audit quality, the NFRA commenced a series of auditor-audit committee interactions, which are being issued on significant areas of accounting and auditing from time to time. This has reinforced the need for quality interaction between auditors and audit committees, increasing the opportunity for better engagement between both sides and boosting the quality of interactions and oversight of the audit committee, thereby helping protect public interest and investor protection. To date, NFRA has issued 4 series encompassing interaction between the two sides, which contain critical questions that the audit committee are normally expected to ask of the auditors. While these questions are illustrative in nature, the key focus continues to be on compliance with existing accounting and auditing requirements, with an objective to enhance quality. Here we focus on the 4 areas covered by the series, some of which, in fact, were issued only very recently. Starting with the first series, which covered ECL, wherein Ind AS 109 prescribes the recognition and measurement of expected credit loss, which while related disclosure requirements and overall credit risk related disclosures are addressed by Ind AS 107 on financial instruments disclosures. ECL recognition and measurement is a complex area of accounting estimate that involves significant management judgment and also involvement of subject matter experts. Some of the questions that the auditor could be expected to ask have been highlighted on the slide. Similarly, taxes, which includes deferred tax and related estimation uncertainty. This was a second series which covered primarily deferred tax and key considerations for the audit committee in the areas of recognition and measurements of deferred tax assets and deferred tax liabilities and their related disclosure requirements, all driven by Ind AS 12, accounting for income taxes. Again, some of the questions have been highlighted here that the audit committees could be expected to ask of their auditors. The next series pertain to related parties. Related party relationships and transactions have been a source of major frauds in corporate history, and some of the modus operandi continues to be seen in recent corporate frauds as well. Some of the RPT concerns stem from the findings in many of the recent reports and orders, including diversion of funds, absence of business rationale, lack of arm's length basis, understatement of loans and advances, evergreening, etc. Clearly denotes management override of controls and absence of adequate appraisals and approvals, to name a few. In this area, some of the potential questions again for audit committees and boards to ask the auditors covering such related parties may include the ones again highlighted on this slide. Finally, recently, the series on effective audit strategy and audit plan is critical phase of an audit of financial statements. Its timely preparation, communication with TCWG, and its appropriate revisions during the course of audit will have several advantages, leading to effective and efficient audit of financial statements. Again, some of the questions that could be expected to be asked of auditors while they present their audit plans to the audit committee have been highlighted in the slide below. In conclusion, what would be important is for auditors to cross-check their existing audit strategy and ensure that these areas are adequately addressed as part of ongoing strategies, and ensuring suitable communication has been made to TCWG in the course and throughout the course of the audit. Engagement teams might want to revisit their discussion with auditors of components and overall ensure adequate inclusion and documentation of these disclosures into their consolidated CFS audit files. Moving to group audits, there have been a lot of debate and discussion in India adopting and aligning to globally acceptable auditing standards, not only as ISO 600 revised become more prescriptive on what parent auditor's role is, the risk assessment process adopted for scoping how the parent auditor is expected to interact with the component auditors, and the level of documentation expected on the group files to demonstrate this involvement are some of the big changes in ISO 600 revised globally. Whilst this is a big change in the Indian context, where there was a divided responsibility in the audit opinion and the access to work papers of component auditors was prohibited under the CA Act, NAFRA issued a circular in October 24 clarifying the scope and responsibility of the parent auditor in line with the provisions of the law. So while the auditing standards are proposed to align from 1st of April 2026, parent auditors are expected to assume full responsibility of the consolidated financial statements audit in line with the current requirements of law. As a result, it is expected that the parent auditor be given full access to work papers and that he be fully involved with the component auditors' planning, risk assessment, and reporting responsibilities. Moving ahead to the hot topic of all regulators in India, related party transaction continues to make headlines in our country. SEBI, through the industry standards forum comprising representatives from the three industry associations, ASSOCHAM, CII, and FICCI, have formulated these standards for minimum information to be provided for review of the audit committee and shareholders before they approve related party transactions. As per the modification, SEBI said the listed entities are required to provide the audit committee with specific information in the industry standards while placing any proposal for review and approval of a related party transaction. These are effective from 1st of April for new RPTs entered from this date. Similarly, the explanatory statement accompanying notices sent to shareholders um, seeking approval of any RPT will include information in addition to the requirements under the Companies Act. These are significant data points that need to be called out in the information that would be submitted by management to audit committees and shareholders. While this is a new and evolving area, the extent of information required and the format in which it is now to be provided to the audit committee has significantly been formalized. A few examples of the extent of information needed and the audit committee's role has been disclosed on this slide. From basic details about the RPT, the arm's length assessment, the valuation basis, to more detailed information on every transaction, such as bids for sale purchase transactions, and in case of loans and advances, details of disbursements, including interest rates used, their basis, the end use of funds, the track record of defaults, etc. Is significant amount of information that is now expected before audit committees are approving such transactions. Needless to say, audit committees will need to dig deeper and review and challenge the information before they recommend these for shareholder approval. Similarly, it is now required shareholders be given access to some of this key information before approvals are sought. This slide summarizes what is currently prescribed. Moving ahead, this is a new concept introduced by SEBI recently on digital assurance. Assurance. According to a recent consultation paper, this initiative will require the production of a separate report on digital assurance. This report is expected to lift disclosure standards, aid in better enforcement, and ultimately secure greater investor protection. SEBI's decision follows extensive consultations with market stakeholders and leverages a technical guide prepared by the Auditing and Assurance Standards Board, AASB, and the Digital Accounting and Assurance Board of the Institute of Chartered Accountants of India. This guide outlines a framework from external data repositories to be mandated for management statements and independent auditing reports. The technical guide emphasizes the utilization of external audit evidence and information, clarifying that it does not impose a separate reporting requirement on the auditors concerning these details. Furthermore, it stipulates that management of listed companies is not obligated to provide or grant access to such externally obtained information to auditors. Based on discussions with market participants, however, it has been decided that based on the aforesaid technical guide, a framework for management statement and independent auditors report on digital assurance based on information provided from external data repositories be mandated. Reporting on digital assurance shall be applicable on top 100 listed companies by market cap from financial year 24-25, i.e. for the period ending on or after 31st March 25, management will be responsible for the statement and the report shall be prepared by an auditor who has subjected himself or herself to a peer review of the Institute of Chartered Accountants and has a valid certificate issued by the peer review board. The deadline for submission is proposed to be 31st July. Moving now on to BRSR core reporting and some of the recent updates and changes proposed by SEBI. So as you may be aware, SEBI had proposed the formation of the Industry Standards Forum in July 23, which comprised the industry associations of ASSOCHAM, CI, and FICCI. SEBI-wide, its circular in December 24 issued the industry standards on reporting, which have been developed by this Industry Standards Forum and are applicable from financial year 24-25. while some specific guidance has also been issued, which is summarized on this slide, in relation to particular items in the BRSR reporting. Other recent updates include, in case of assurance for listed companies, this was changed to assessment or assurance for BRSR core, applicable from 24-25. ESG disclosures for value chain have been deferred by 1 year to the following year, FY 25-26, and the assessment or assurance on that to FY 26-27. These disclosures would be voluntary, not on a comply or explain basis as was earlier proposed. The entity may limit disclosures to 75% of purchases or sales by value, and the previous year numbers, again, for year one, would be voluntary. With that, I think we've so as you may be aware, SEBI had proposed the formation of the Industry Standards Forum in July 23, which comprised the industry associations of ASSOCHAM, CI, and FICCI. SEBI-wide, its circular in December 24 issued the industry standards on reporting, which have been developed by this Industry Standards Forum and are applicable from financial year 24-25. While some specific guidance has also been issued, which is summarized on this slide, in relation to particular items in the BRSR reporting. Other recent updates include, in case of assurance for listed companies, this was changed to assessment or assurance for BRSR core, applicable from 24-25. ESG disclosures for value chain have been deferred by 1 year to the following year, FY 25-26, and the assessment or assurance on that to FY 26-27. These disclosures would be voluntary, not on a comply or explain basis as was earlier proposed. The entity may limit disclosures to 75% of purchases or sales by value, and the previous year numbers, again, for year one, would be voluntary. With that, we draw close to this session on key updates and highlights for FY 24-25. Thanks for listening, and until next time, thank you, and good luck with the year end.